100 years of stock market history gives us two facts that stand in contrast. The US market has been a powerful wealth machine, but the typical stock has not. ASU professor Hendrik Bessenbinder just updated his much followed market analysis with a full century of data covering more than 29,000 US companies from 1926 through 2025. His work shows that the value-weighted market return compounded at 10.1% annually versus 3.3% for one-month Treasury bills. Yet, the median individual stock lost over 6.9% over its lifetime, and only 41% beat Treasuries. Moreover, over a 10-year horizon, fewer than half of stocks beat T-bills in each of the last 4 decades. The reason is that stock returns are heavily skewed. Of more than 29,000 stocks, just 1,082, or 3.7%, created all $91 trillion of net wealth above Treasury bills. Just 46 companies created half of it. In a market increasingly dominated by ETFs and passive flows, the takeaway is that stock selection still matters. Shifting gears, we wanted to cover the latest on the AI trade, which remains the dominant market theme. After a torrent run, the Philadelphia Semiconductor Index is down roughly 16% since its June 22nd peak, despite several outstanding earning updates from key index members. Meanwhile, the UBS Hyperscaler Index, which has lagged this year, is up about 5%, a 21 percentage point spread in about 3 weeks. What accounts for this change in investor sentiment? We think this is less a weakening of the AI thesis than a reassessment of who captures its next phase. Semiconductors have been a fantastic trade over the last year, but investors have yet to fully internalize the capital expenditure needs across many parts of the semi-supply chain, which could pressure their pricing power and cap their valuation multiples. Even after the pullback, semis still trade near 24 times forward earnings, elevated for what's historically been a cyclical industry, versus under 20x for the hyperscalers, whose earnings are more stable. Unlike CapEx for the semis complex, the hyperscalers' CapEx plans are by now well understood, with an underappreciated potential for a free cash flow inflection after 2027. Free cash flow for the 4 largest, Microsoft, Alphabet, Amazon, and Meta, is expected to trough near $52 billion this year, then recover to $220 billion in 2028, and nearly $390 billion in 2029. Of course, expectations could change pending company guidance, but the year-over-year spending growth rates that drove free cash flow lower are unlikely to be as large going forward. While there are certainly risks of higher spending or AI cloud revenues not materializing, we think the cautious expectations make for a constructive setup. Please let us know if you have any questions or feedback. Thank you and have a great weekend.